All right, good evening, everyone, or good morning. I don't know what time you're going to be looking at this, or maybe you people over in Europe are looking at it. It's in nighttime, AM time, or whatever. This is Louis Porcelino with ManoverMarket.com, and I'm giving you an update. And today, I thought I'd give you a little bit of a change up. I want to take a look at this is a daily chart of the ES, and this was the range today. And one of the things that we stated today, my partner Pat Tabbitt said that usually in downtrending markets, you usually don't get more than two higher closes before you continue on the downside. So we kind of stuck our neck out there. So we had a higher close here from Friday, and then this would be your second close because it's higher than Friday's close. Now, the reason I put the daily chart up here, this is a daily chart without overnight action. Because back in the day when I was trading in the pit and there was no electronic markets, we used to look at gaps. So if you take the opening or the close of this on Friday, that closed at 1923 half, and you look at the opening of this bar, which was today, that was 1934. So you approximately have about 1,000 point gap between the close and the opening. In the old days, we always knew and thought, and it was sort of a rule of thumb that gaps always get filled. Gaps always get filled. Now with electronic trading, you don't see these gaps, and they show up on charts as single prints or long buying tails or selling tails, and they're just single prints when you're taking a look at a market profile or something. So, a couple things. Big down day. We're looking for distribution. We had a retracement. Okay. This is our second higher close. But interesting thing, and my partner pointed this out today because he is the king. Pat Tabbitt is the king of charting and understanding and looking at things that people don't really look at. And he has all kinds of books on his shelf and a photographic memory. So he looked at this and he told me this is called a long upper shadow. A long upper shadow. So a long upper shadow is defined by the fact that the wick that you see here, qualifies to be 2/3 of the daily range. So we had a 975 point range today with a 1 1/4 low and a 41 high, and the wick is from 34 to 41, which is 72% of the range. And to qualify for 2/3, it was 66%. So we've got a couple things going on here. I gave you an old chart, the old way of looking at a chart, because this is a gap opening, what we call a gap opening. We've had two higher closes coming from a downtrend, and now we have what we call the long upper shadow. So, we'd be surprised tomorrow if we don't get some backfill, some retracement, and if we take out that 27 area where we were looking today as our bull bear range, I think we could retrace back to the 23 area. So, hopefully, this has been a little educational process, and maybe for you people that are out there short, this is helping you stay short, and for the people that are long, beware. But at the end of the day, markets go. As I had a clerk one time, and he used to tell me the market's either going to go up or down from here. So the key is figuring out what the time is, right? So this is Louis Porcelino, manovermarket.com. And remember, our service is free. All you have to do is register and take a look at all the things that we do offer. We offer our research, we offer our trade alerts, and our constant updating throughout the day through vis-a-vis our pop-up window. All you have to do is leave it minimized on your computer, and what we have to say pops up right on your screen. All right, everybody, have a good evening or have a good morning based on when you open up this chart. And as I say every day, good luck and happy trading. Talk to you soon. See you in the morning.